Home Depot. Okay, when you picture it, you probably see, endless aisles of lumber, paint, tools, right?
The classic image.
Exactly. But this company, it's actually so much more. It's really a barometer for the U.S. housing market, a dynamic battleground for retail innovation.
And a financial powerhouse. I mean, over $150 billion in annual sales. That's huge.
It really is. So with the stock currently near its all-time highs, the big question for you, the listener, is that price justified?
Yeah, is it worth it right now?
That's our mission today, a deep dive to sort of deconstruct this orange apron giant. We'll explore its legendary founding,
And uncover that powerful business model.
crunch its fascinating financial journey, look at some key risks.
And finally, try to figure out what its stock is really worth.
Okay, let's unpack this.
Let's do it.
So it all kicked off not in some fancy boardroom, but actually in a Los Angeles coffee shop back in 1978.
Right. Bernie Marcus and Arthur Blank, they'd just been fired.
Yeah, and from that setback, they envisioned this completely new kind of store. Massive warehouses, incredible product variety.
But crucially, staffed by those highly trained orange apron experts, people who actually knew what they were talking about.
Exactly, and that focus on service seems key.
Oh, absolutely. What's truly fascinating here is how that initial vision, being in the people business, not just selling products, became a really powerful competitive moat.
Built loyalty, you mean?
Deep customer loyalty. And it's a culture that still seems to persist today. You see it championed by the current CEO, Ted Decker, who's a longtime company veteran himself.
Right. So beyond just, selling drills and 2x4s, how does Home Depot actually make its billions? What's the secret sauce there?
Well, a huge part of it is the pro customer, the professionals, the contractors.
Yeah.
Think about this. Well, they're only maybe 5% of Home Depot's total customer base.
Only 5%. Wow.
Yeah, but they account for an astounding 45% of annual sales.
45% from just 5% of customers.
Exactly. And Home Depot didn't just luck into this. They actively built a dedicated ecosystem just for them. Things like Pro Extra, that's their specialized loyalty program with discounts, dedicated service,
Wow.
and even direct-to-job site delivery. That kind of integrated approach, well, it's a significant barrier for online-only players to even try and replicate.
Makes sense. You can't deliver drywall easily from a central warehouse miles away.
Right. And their omni-channel strategy is, frankly, masterful. Roughly 60% of their online orders are actually fulfilled directly through their physical stores.
So people order online, pick up in store, or delivered from the store?
Both. It blends that digital convenience with their, 2,300 plus physical locations. Really smart.
Okay, let's talk financials. Looking back over the past decade or so, it feels like a story in 3x. We had that steady, predictable climb pre-pandemic.
No, solid growth.
Then, boom, an unprecedented surge. They added over $47 billion in annual sales in just 3 years.
Absolutely wild numbers during the pandemic home improvement boom.
And then more recently, what some are calling the Great Normalization, their first sales decline in over a decade in 2023.
Right. But it's really important to frame that correctly. This isn't a sign of a struggling business. It's more like a stabilization, but at a fundamentally higher level.
Higher than before the pandemic surge.
Oh, yeah. Fiscal 2023 sales were still over $42 billion higher than pre-pandemic 2019 levels. So for investors, you might see this as a new, significantly elevated baseline for their revenue potential.
Okay, that's a key point. And while we're looking at the books, something you might notice is negative stockholders' equity. That sounds bad, right?
It sounds alarming, but in Home Depot's case, don't let that be a red flag for you. It's actually a deliberate feature.
How so?
It's a result of their really aggressive share buyback program. They've returned so much capital to shareholders over the years that it technically reduces the book value on the balance sheet below zero.
So they're buying back their own shares?
Consistently. And funding it with billions in operating cash flow is actually a strong sign of a mature cash-generating business rewarding its owners.
Got it. But no company is perfect, right? They've had challenges. I remember that massive data breach back in 2014.
That was big. 56 million payment cards compromised.
Yeah.
Cost the company over $200 million directly.
Beyond the money, what did that do to trust? And how did they, fix things?
Well, it forced a complete overhaul of their security. Cybersecurity became a board-level priority, not just an IT issue. It was definitely a painful lesson, but it led to much stronger safeguards. You have to hope, anyway.
Okay. Any other risks investors should be aware of?
Another key point for you to consider is concentration risk. While we often call Home Depot the world's largest, its operations are heavily concentrated in North America.
Meaning mostly the U.S.
Primarily the U.S. and Canada. Their combined non-U.S. operations actually contribute less than 10% of total revenue.
So they're really tied to the health of the U.S. economy and housing market.
Inextricably tied. Makes them vulnerable to, say, regional economic downturns here or specific policy changes affecting housing or consumer spending in North America.
Okay, so putting this all together,
Yeah.
What does it mean for the stock price if you're thinking about investing? We looked at it through the lens of Benjamin Graham.
Right, the father of value investing. And his formulas, well, they reveal a classic dilemma for investors looking at Home Depot today.
How's that?
The strict Graham number, which is really focused on tangible book value and current earnings, suggests the stock is massively overvalued.
Mostly because of those share buybacks pushing down book value.
Exactly. But then you look at his revised intrinsic value formula, which puts more weight on future earnings growth expectations. And that's just, it's maybe only moderately overvalued. But that comes with a big if you believe Home Depot can continue delivering strong earnings growth.
So conflicting signals depending on the formula.
Pretty much. What's clear, though, is the market consistently gives this stock a premium valuation. It rarely looks cheap by traditional metrics.
Okay, so summing up, Home Depot, undeniably a blue chip market leader. Powerful moat with that pro-business, best-in-class omnichannel.
No question. But it is cyclical. It's inherently tied to the housing market, which can be unpredictable. And at its current price, well, it's certainly not flying under the radar as some kind of secret bargain.
Right. So the decision to invest, it really seems to boil down to your personal strategy, doesn't it?
Absolutely. Are you a strict value investor? Hunting for a deep bargain? If so, this probably isn't it right now.
Or are you willing to pay what might seem like a fair, maybe slightly premium price for a world-class business with a really strong track record of rewarding its shareholders?
That's the trade-off. We've laid out the facts as we see them, crunched the numbers, looked at the risks involved for you.
The final call, as always, is yours.